welcome everybody to our ETF Think Tank Captain's Log, episode number 2. This is the show we created to talk about the latest ETF trends, things that are going on in the ETF market that we find interesting. And we get to pick our CIO's brain in this show, which is Mike Venuto. Or everybody knows him as the OG ETF nerd. So we're very excited about this series because we get to hear what Mike thinks about all this stuff that's going on in the ETF space. And today we're going to talk about active management. I think we are a little bit obsessed with it in the ETF space. I remember, I think it was back in 2012 in January when I went in a previous job working for our previous publication. I remember the headline was, active management has finally arrived. And so we've been predicting a significant arrival of active management ETFs for at least 10 years. But it looks like this year it's actually going to stick. It looks like there's some interesting forces behind this trend, behind not only product development, but adoption. So we're going to talk about all of that today. So
yeah, I feel so much to cover. You and I'd like to do a little bit of homework. I feel like I don't know how we're going to get this into an hour.
We're going to do our best.
Yeah.
So
I think anecdotally though, we should also, call out, the core business behind Tidal, which is, the ETF Think Tank is a part of Tidal Financial Group, is helping people launch and grow ETFs. At this point, 2/3 of the ETFs on our platform are active. And I would say 9 out of the 10 ideas that we hear on a daily basis are active. So, from a white label perspective, if you're a manager out there and you want to launch an active ETF, give us a call at Tidal. We'll still talk to you if you're passive, but it does seem like there is a tidal wave of active management embracing the ETF structure today.
Yeah, and we're curious, is this because that's where the white space is, or is that because the fees are a little friendlier for the product providers? What is it that is driving this phenomenon? So, if we're looking at some numbers, I was pulling some numbers. So, Bloomberg just put out their global outlook. They just distributed Inside ETFs a couple of weeks ago. And he notes that if you look from 2019 to today, out of the 25 most successful product launches, 19 of them are active. And it isn't because all of a sudden active management has revolutionized the way we invest. It's because maybe fees aren't as important anymore. That race to the bottom seems to have abated a little bit. And it's really a story about opportunity for product managers. It's a story about distribution channels. So, all the conversions that comes with a lot of assets and existing track records. It's model portfolios that are helping the distribution. So, from where you sit, Mike, the conversations you're having with would-be product providers, what's this insane appetite for active management?
All right, so you said the numbers, and when we talk about the numbers supporting this, I like to go to our KPIs. So I'm going to go to that to kind of outline some of the answers to the questions you just posed. So let me pull that up here. So this is our KPIs, and if you're interested in ETFs, you need to sign up for this at the ETF Think Tank, and it's something that we put out every Monday. Usually Ryan writes it. Have had a big girl, so Cinthia had to write this week. So I'm pulling up this week's actually to give the context. All right, so this is our KPI chart and has various different metrics on what's going on in the ETF industry. And the one number that I think really highlights what you were talking about is this percentage of revenue of the industry coming from active management. That's a big number, 13.1%. And what makes that a big number is relative to the size of the active management in AUM, right? So if I come here, this is also on the website, our ETF finder. And if I come here and I just click in active, give it a second, we see that active has a little over 1,000 ETFs, and they represent $397 billion. Right. Now, that's like less than 5% of the overall assets. So 13% of the revenue and about 5% of the assets. So yeah, that makes it a real attractive place to go to. And, uh, it's a scary thing for the smaller index providers because they're now an expense. Now I want to go back 3 years. So it's almost to the day. This is the KPI. It's also on our website from 3 years ago. The revenue that Active produces has doubled in the last 3 years. The assets have not, though. And it's the expansion. The assets have gone from about 3% to 5%, but the revenue as a percentage of the overall industry has more than doubled. So I find it really interesting what this has done to change the space. And there's a number of reasons why, which we're going to get into later in this discussion. But yeah, the acceptance of Active and the opportunity to make a little bit more money is really there, right? So if I come back to the Finder, we see the average weighted expense ratio for Active is 38 basis points. Put that in context. Oh, and by the way, that's still like a fraction of what mutual funds charge, right? So we're not talking about high fee stuff. Now, if we go to non-traditional indexing, which is our boring name for what everybody else calls smart beta, which we've declared dead multiple times, but it doesn't seem to want to die. Let's see what the average weighted expense ratio is there. 22 bips. Not a surprise, a big, almost cut in half. Call it down by 40%. Now we'll go to traditional beta indexing, right? And we define this as anything that's, broken down solely on a sector or market cap or geography. And we're down to 0.7 bips. So yeah, this is the only opportunity set out there if you're entering this world. We've seen almost no traditional indexing stuff launched anymore, unless it's a JP Morgan or a Franklin filling in something for their existing clients type thing. We see very little smart beta or non-traditional indexes right now because, why pay an index provider when you could do it active since so many others have paved the way? And 4 times the fees. Yet even at 4 times the fees, you're still a fraction of what mutual funds are charging. So
well, and so 2 things that I think are interesting that when I was pulling up this data earlier today is just for all the passive talk, only 545 traditional beta ETFs versus already 1,100 active. Like that was surprising to me. We already have twice as many active as we have just plain beta ETFs, which I think is kind of fascinating.
Yeah, and I think it does make sense that they'll continue to get assets, right? Because if betas become essentially free, well, people get it essentially for free, and then they'll look for more interesting things in the active space. And we'll get into the real value props of active because I think it's really changed over the last 20 years. So
let me just throw in a flows number for perspective. So I was looking at, and for flows, I look at ETF.com data. They track the flows closely every day. So far in 2023, a third of the flows, just over 30%, have gone into active ETFs. In the entire calendar year of 2022 was about 15%. So we're already at 2x the pace in asset gathering and active ETFs. That said, the overall flows into the ETF space is more than 40% slower this year than it was last year, and which last year was already a 35% decline from the year before. So the asset gathering pace in the ETFs have really slowed down given market conditions. We know the market has been a great money incinerator, but active is representing a much bigger slice of that pie. So that I'm sure that is playing a role into encouraging, product providers and asset managers to launch active ETFs and really, look hard at what is it that they can offer in that space.
Yeah, and I think this year's a weird anomaly because it does feel like the market is incinerating assets, but as of the recording of this, the S&P is up somewhere between 9 and 10%. So it doesn't feel like that. Now, that 9 and 10% is basically Nvidia, Apple, Facebook, right? So it's like 5 stocks or whatever. So anybody doing anything other than the mega cap techs don't feel that great this year. Thing this year is mutual funds finally got a bid, and it's not all mutual funds. It's a very small section of it. It's money market mutual funds. Now, last year we saw a lot of money start to flow into short duration fixed income ETFs, most of which are active and are the history of active ETFs, actually, which another thing we'll cover later. But in the US, the regulators haven't allowed us to use the ETF structure for our money market fund. They do exist in Canada, and they saw massive inflows. So it's interesting. It's like mutual funds seem to have like these Alamos. I've always said 401ks are their Alamo, but it also seems like money market funds are as well. So they've got these like little entrenched regulated areas where they have like strange advantages, which I imagine will break down over years.
Yeah, yeah. So let's look at the history of active. We were talking about this yesterday in preparation for this, some of the interesting finds as we look at some of the veterans in the space and how this space has evolved. So give us the rundown of the oldest
Yeah.
ETF.
Yeah, so this is going to be fun. So to put history in context, active management was the only thing that existed until about 45 years ago, right? Now I'm 46, so like I'm about the same age as passive management. Now, the concept of active management from 1929, when Wellington launched the first active fund, till 50 years ago when Burton Malkiel writes Random Walk, was take the broad-based group of stocks that are in an index, right? Basically S&P or Dow Jones, pick the ones that you want to overweight, pick the ones that you want to underweight. So most of active management for its first 30 or 40 years really was index hugging. Right. And even today, a lot of what's left in active mutual funds, especially, is quasi-index hugging, right? They're taking what was historically thought of as a research tool or a benchmark, which was an index, and they were overweighting and underweighting versus it because it was obvious that you can beat this, right? Like, of course, active management can do better than just picking the largest company. And it just didn't work out that way, right? Like, some of it is self-fulfilling, right? In that, if the flows are going to go to passive, and passive is designed in a structure that allows for the largest companies to float to the top, you have this interesting, call it self-fulfilling prophecy. Now, I think it's hard to think of that kind of active as what's succeeding in the ETF space, right? So I'm going to bring up the screen again and go back here. So let's see, let's find the piece that I wanted to share.
Yeah, I think it's, as you look for it, is just that idea of, to your point, closet indexing versus rules-based active versus unconstrained active go anywhere approaches, right? There's different ways to look at
Yes. And you know what? The piece that I wanted to share, I can't find it. So I'm actually going to go here. So two things. One, Meb just did this great podcast with Burton Malkiel, who wrote 50 years ago about the idea of passive. To understand where we are with active, you really need to understand the history of passive. And this really takes us down the memory lane of Random Walk and the concept being introduced, and the first ETFs being launched around it and the first mutual funds being launched around it. Highly encourage people to go listen to this story of passive to understand the value of active. Right. Number two, in the world of ETFs, the history's been kind of strange. So I'm going to go to another one of our tools, our Security Master, which I think I have open here. Yes. So in here, we have a list of all the ETFs that have ever been dealt with and all that sort of stuff. And I decided to look up the history of active ETFs. Now, this is where it gets really strange. So not in here is an ETF that was the first ever active ETF launched. It was ticker IY and some sort of income thing from Bear Stearns. It closed, and then our partners over at Amplify used it to create a new ETF that's passive, ironically. So that buys closed-end funds. So yield, yield, yield. So it's interesting. The first ever active ETF launched is no longer out there. The second thing that stood out to me on here was that YYY was launched in 2008. But you see the first 20-ish funds actually have inception dates before 2008. That's because they're all conversions. So the irony is this Bridgeway fund launched in 1997 as a mutual fund is the oldest active ETF in existence, but it was launched. I mean, it was converted way after the first launch of an active ETF. So it's just like, it's so ironic to the whole process. There's a couple others in here that were passive ETFs that converted. There's a lot of stories about Guinness Atkinson and their big conversion to smart ETFs. You know, JP Morgan Realty Income, one of the a 1997 mutual fund as well that converted to an ETF, let's say in 2022. The Bridgeway fund, I love that even the disclosure. So this is theoretically, this is now the oldest active ETF in existence, even though it's only been an ETF for a few years. It actually talks about the predecessor mutual fund so that they could port the track record. So I found it really, really interesting, that concept. And then the next thing that stood out to me, let me go back there.
Yeah, because conversion didn't really start until I think was what, March 2021 we saw the first one. So I mean, they're 2 years old at the oldest. But they really now skew the history as we know it. It's kind of an interesting wrinkle.
Yeah. Like everybody said, oh, dimensional funds is too late. No, they're not too late. They're doing quite fine. Right? So let's actually then go to what is the oldest active ETF still listed that was launched as an ETF and was active when it launched, right? So it's not the Wisdom Tree one because this wasn't active when it launched, right? They added AI to their value ETF to restart the story. It seems to me
Is it GSY?
It's GSY. It's part of this of a couple of these Mint. There was a number of these fixed income ETFs that came out active early on, which culminated in Bond in 2012, which I think is where your headline of we finally made active. But if you notice, I don't see a single equity one that survived or was launched. Well, I guess there's this Invesco real estate one, but I have a feeling that's a conversion as well. So it's funny. I guess the key story here is active took over fixed income before it took over equity or allocation or options or anything else. It was the early iterations of active are very fixed income oriented.
But so doesn't that support the story that active works where there are inefficiencies to be harvested, right? So like in a way in the equity space in the last 18 months, let's say, the adoption of active has been because markets got challenging, correlations got screwed up. So all of a sudden, the narrative anyway is that the active managers can go and find opportunities that just tracking the market doesn't. And the bond market by design is clunkier than the equity market, right? Is more difficult to access, all that stuff. So maybe it was naturally conducive to active management before equity had a trouble spot to do it.
You know, it's funny. I think it's actually my approach on it is a little different. It's the fixed income market was not ripe for indexation, right? So like even I can listen to Burton Malky, will make the case all day long as to, you know, why market cap weighting works for equities. I may not agree with it 100%. I see inefficiencies there. I see mistakes that are created. but I see the logic of it, right? It's liquidity, it's market cap, it makes sense. Now go to fixed income. If you're owning the ones on market cap, that means you're owning the companies and debts that are the largest. That sounds like layering in risk. So I think the lack of a obvious way to passively index fixed income has allowed it to go active first. And this is actually a paper that I pulled up that we wrote way back in 2018. This is another have ETFs active stories, right? We were talking about it back then too. This was surprising to me though, because I remember this when I wrote it. I went back and looked at it again. And at this time, the average fee for an active equity ETF, which is funny, was 20 basis points. And for fixed income, it was 22. Now, we just looked at it and we're up at like 33, I think. Right. So this is a place where fees have actually expanded. But it's amazing that just as few years ago as 5 years ago, 2018, fixed income commanded a higher fee than equity. And I think it's because the few ETFs that were really out there back then that had assets weren't that active. They were kind of those quasi index huggers that we were talking about in the mutual fund space. I think what really broke this was Cathie Wood, right? Cathie Wood, I remember when ARK first came out. Actually, I was at Global X at that time. Our attorney for our trust moved over to ARK, and she was all excited. And I remember seeing her a year later, and she was miserable. Like, we're doing all these things right, and we have all this conviction, and nobody will buy our stuff. And I was like, well, it's active. Nobody wants to buy active, right? Like, and then she stuck to her guns, and she really did something. Like, to me, the pioneering moment was running into the transparency, accepting that I've got to show what I own. So rather than, hide from it, I'm going to make it my attribute. And I really think that, combined with insanely good performance for a period of time, broke down a lot of barriers. But I think that gets to what's different about this wave of active in the world of ETFs versus that history point that we were talking about earlier. The 1929 Wellington kind of funds, the index huggers, they're not particularly a gathering and launch. We don't see a lot of those coming to us. What we see are more like high active share funds, right? High things that are doing something very different than the indexes and doing it actively. And I think this is one of those places where we're going to say regulation has helped. Which, how often do you say that, right? So in 2019, we had Rule 6C11. They called it the ETF rule. And everybody makes it out like that changed things so much. And it certainly helped. Probably the biggest benefit to active is it added the use of custom baskets, which is to active management, which is the tool us ETF nerds use to make ETFs extremely tax efficient. So passive had an advantage over active until 2019-ish. Now that's gone. The rule that came next, which was called 18F4, which is called the derivatives rule, this one had an even bigger impact on active because it basically opened up the use of leverage derivatives swaps to everybody. It broke the it's not a monopoly. Well, it's a two-company monopoly. I can't remember which monopoly.
Direction.
Yeah. They owned leverage. They don't anymore. And actually a lot of the 3X stuff that they could do, they won't ever be able to do again, right? So like it democratized access to a whole new suite of really active managers that are doing things with Delta 2 and Delta 3 things that have rates of change more than the underlying Delta 1 asset. So that's really been a game changer in what we're seeing coming to us. So like the active management that's coming to us, it's never, oh, I want to buy, I'm going to do like a value fund that overweights like, 3 stocks in the S&P and I'm going to charge 6 times as much. Like that shit doesn't happen anymore. What comes to us now is I want to do an options overlay with the this and the that and the the complex stuff. And our team is really good at figuring out the complex stuff.
But what I think is interesting is that, you can create product all day long unless somebody's wanting to buy that product. It's just an exercise in vanity in some ways, right? So I think what's interesting to me in this whole thing is that the actual flows are there, just broadly speaking, like, twice the pace of last year, all that stuff. But I also think it's interesting that if you look at the biggest active ETFs, the ones really gathering assets, I mean, it's your JP Morgans out there, JAPI. I mean, we can't stop talking about that fund
And it's doing something complex and different, right? Like you wrote 2 papers on this. Like I didn't even know equity linked notes existed till you wrote about that. Like who the hell knew that was in an ETF?
but it's just kind of, I'm just curious to see, like, now that we have momentum on both sides, the demand side, or at least the everyday investor's willingness to at least consider active ETFs. And then you have all this product development. Is there a point where it's enough and we just start seeing what we saw in the passive space? Just the biggest funds get bigger, the vanguards of the world just get bigger. And all this innovation by the 100 smallest issuers just kind of sits there and struggles to find, because at the end of the day it becomes a distribution story. So I'm just curious to see how it all shakes out.
I think Kathy broke that wheel. I would say a lot of people have done some things different, because when you get to active, you can have BlackRock launch an innovation fund, but is anybody going to believe in them? Like the passion, the IP of an index is a lot harder to protect than the IP of an active manager. So I think there's something interesting there. And, I start to think about how to look at these things. So we talked about old active management. Here's what I'm seeing in trends of new active management. We've already talked about complex. We've talked about high active share being very different than the benchmark. I've also seen, and we were part of this revolution with our partnership with Amplify on blockchain, right? So we did BLOK with them. And when we first had the idea, we had an index provider working with us, and we looked at it and we said, this is good, but this world is changing so fast. And how is an index going to that are really doing this versus ones that are just putting blockchain in their name? And so there was a story that I think has proven out to be quite true, of some of these thematic ETFs really need to be active. Now, we came out active. We now have 20 passive competitors, but they can be some passive funds now in that space, because now the industry has matured. We just saw the exact same thing with our partners at Roundhill when they launched Chat to focus on generative AI. And the same story. They wanted to go active because they knew things were going to change rapidly in this space. I've seen a number of other thematics make this case, and there's a strong case for thematics, especially in exponentially changing areas, to be active. Another thing that I've seen for active is what I call structural inefficiencies, or almost regularly mandated that they be active. So the screen share here and pull this up. So if we go back to our list, so we talked about GSY being essentially the first one that's still alive. CYB, CEW, these are not funds that are really active, but they were mandated to file as active because you couldn't create an index to really track currencies, because you had to do things differently. So there's a number of these nowadays that aren't really active funds, but have to be filed actively to do more creative things, even though their real goal is to provide essentially a passive exposure. So I think of the risk parity fund that is one of our clients, the Evoke folks. They have RPAR. RPAR follows an index, but because they have use of treasury futures, which essentially create a portfolio that's levered long, that can't be filed as passive. right? In order to do more complex indexes, you actually have to regulatorily be mandated to be active. And we're seeing that with a lot of these things. Like there are a number of single stock funds that are essentially some form of leverage. That's not really active management, but it has to file as active because in order to implement it, you have to have discretion on trading the underlying swaps and things like that. So the regulatory mandate is an interesting play. The next thing I like to think about though is how do I look at these things? And this is where I love what we've created in our security master. We think of it as our way of gridding out ETFs, and our security master that anyone can access on ETF Think Tank has these kinds of metrics in it that you can look at. And essentially the concept is, how do I segregate the differences between passive, smarter, rules-based, and active? And we also on the y-axis, or is it the x-axis? I always get that part wrong. I'm pretty sure it's y. We have a measure of diversification. And it's almost intuitive, right? That more concentrated active funds are the most expensive.
Mm-hmm.
And surprisingly, out of all active, have garnered the most assets. And then the cheapest is the most diverse smart beta, traditional beta funds, but has garnered the most assets out of everything. So this chart, I feel like when you look at it, the intuitive nature of where you would expect things to be really plays out. I do expect a change now that it has made such an impact and coming in their conversions, because they're going to fall into the diverse category of active.
Right.
But
Yeah, but
to me,
it
this is a
really,
really good starting point.
this is really like, to me, a chart about conviction. So if you don't think you can beat the market, and you just want to go passive, which is why a lot of people adopt passive funds, you just go with the cheapest, most diverse option. This is a story about diversification. And then in the active space is about conviction on an active approach. You're willing to pay more for that. So
Yeah.
this totally makes sense. But
And I would say most of what comes to us is in this, I would say, semi-diverse to concentrated bucket. We see very little coming to this active space for diverse. I think that game has already been won by dimensional funds. They won it 30 years ago before the ETFs existed. So it's just been democratized and enhanced with the ETF structure.
Well, so, at Inside ETFs a couple weeks ago, talking to just different advisors, and active was a big topic of conversation. And, you still hear advisors say the big hurdle to adoption is actually the due diligence on active managers. And so, let's talk a little bit about that. How do you go about assessing what an active manager brings to the table? And I wonder if that's also why you see the big companies like your Dimensionals, JP Morgan's kind of winning that race in a way, because these are well-established brands. It's a lot easier to explain to a client why you're buying a DFA active fund versus go to explain why you're buying XYZ from a small provider that may be new to that client. So let's talk about due diligence in active management. What does that look like today?
Yeah, so I'm gonna bring you all to the ETF Think Tank tools because this is when our team and our investment committee is thinking about building our think tank models, we use all these tools. We also use them in helping decide which ETFs to launch or to help a client develop something. But many of these tools were developed to evaluate ETFs. So I'm going to run down a list of a couple that we use. I'm going to start with the comparison tool. So I'm going to take an active manager and put their product in there to first just get a landscape, a universe of things to compare them to. I'm going to use our friend Meb Faber over at Cambria Funds, because I think he's about to hit his 10-year anniversary on this active fund, SYLD. So this is shareholder yield. And what it does is by putting in there, it gives me a universe of securities where he has overlap. Now, I'm going to ignore this one since it's his own fund and it's, he's using his fund inside his fund. So I'm really going to compare it to these other funds. Now, first thing that stands out to me is SYLD really doesn't have a pure competitor, right? The
Mhm.
closest thing is 30% the same. So right off the bat, I'm feeling like, okay, this thing is unique. It seems like it has a value tilt. I'm not sure what leader shares is. Oh, not surprised that the buyback is in there because that's part of shareholder yield.
Mhm.
Distillate's kind of a value SEI. So let me see, I've got 5 now. So I've got 5 funds that I can look at. Oh, just because this story's been everywhere, I'm going to put the 6th one in. All right. I mean, it was like one of those ones that took in a ton of money. So let's take a look at that one too. Right. So then the first thing I want to do is look at it from a, call it, trading perspective. Right. So I want to know on average how much of it's trading, what the last 12 months of returns have looked like, the volatility, relative strength, and average spreads. And this thing looks pretty decent on all of those things. Right. So I'm not going to worry too much there. The next thing, if I'm a fundamental investor, I want to look at fundamentals, right? So now I can compare the price to sales, which looks like it's the top there. Let's see on PE, second on price to cash flow, second on price to book value, first
Mhm.
yield, first. From fundamentals, this thing is kicking ass.
Mhm.
So now I've got a universe. I can kind of think about it and compare these. I'm probably going to go do research on 2 or 3 of these others, anyone that stood out as having really good metrics, before making the decision whether or not I'm going with this concept. Right. So the next step is to decide, am I getting what I'm paying for? So for that, we use the smart cost calculator. Right. So we now have a universe. We can think through that. I also want to look at the smart cost. So smart cost is the idea of looking at the active share versus the fee versus the benchmark. So I'm going to say the benchmark here is the S&P. I might be able to do more of a VTI here, but we'll start with the S&P. Just as a broad-based beta. All right. So
Hmm.
look at that active share.
Wow.
4%. So that means 96% smart, doing things different. And the overall expense ratio for this is 59. We subtract out what you would pay for the 4% of beta, and it comes out that the smart cost is 52. What that means to us is we always want the smart cost equal to or less than the stated expense ratio, because I don't want to pay for something that should be essentially free or 9 bips or whatever. I'm going to try this again versus VTI. I'm doing all this off the cuff, so if it ends up looking bad, Meb, don't get mad. uh, no, I mean, this is research, right? You're doing the real research. All right, so actually this number, again, 4%. It's actually a few more securities overlap, 97. Smart cost at 58, which is still less than or equal to. So from a cost versus what am I getting perspective in terms of active share, this fund passes the test twice.
Mhm.
Right. The next thing we like to do is think about concentration. So concentration, we use our concentration app, and I want to know if I'm buying a fund that I expect to be the benchmark over 50 bips over a 10-year cycle. I'm not really looking for concentration, right? If I'm looking for a fund to play a theme short term, I want a lot of concentration.
Mhm.
So with SYLD, I'm going to compare it to cows because that was the one that came up. It's not perfect, but it was one of the competitors. And I'm going to say, okay, if I'm trying to get concentrated exposure to this theme right now, I'm actually going to pick cows over shareholder yield. Now, that's because shareholder yield is more diversified, substantially more diversified on multiple different metrics. If I'm looking for a long-term buy and hold, I'm going to pick shareholder yield over cows. Cows is going to have substantially more volatility as a concentrated position. So it's a tool for thinking about how it's going to fit into the portfolio.
And in this
Now,
case, SYLD got the little banner pin because it's more diversified, right?
correct. Yeah, we start with the most diversified, but I don't ever tell people that's the one you want to pick. That's the one you want to pick if it's long-term buy and hold. If you're looking to express a theme for 3-6 months, usually you want to go with the more concentrated one. If you're making a trade, concentration benefits you. If you're making an investment, diversification benefits you.
Yep.
The last thing we like to do is think about the manager themselves, right? So do they got their shit together? Right? Like, to put it quite simple, what does their business look like? And a lot of times we like to come back here and look at the overall business and how they're doing. So I'm going to put Kane, and they've got 12 ETFs, 1.8 billion, average 150, 49 bips. I mean, I'm not worried about this company, and they promote their transparency. Like, I'll, full disclosure, I'm on their board, so I'm using them as an example, right? But these examples of ways to think about active management and how to evaluate it, in the new world.
As a final thought on this process, on our notes, you were highlighting the idea of active as a service, as something that stands out in this conversation about, why active matters now. What do you mean by that?
Yeah, so at Title, where we help others launch and grow ETFs, we think of active management can also be a service, right? So Amplify comes to us and says, we want to do a blockchain fund. We say, well, I can put Dan Weisskopf on it, Ryan Fitzgerald on it. We can build a team and offer you active management in a place where we don't think passive will work. We have another client come to us, Zega. We want to do something, the Yield Max suite. Okay. It really is creating a passive exposure, right? You're generating a yield off of single security, but it requires active management to actually execute. Same with the RPAR. So there's this concept now where active management isn't necessarily trying to beat something or match a benchmark. Sometimes it's a service of producing an outcome like a yield or matching a theme like blockchain or AI. These are not Wellington approach.
Yeah. Yeah, which is kind of like the broader concept of ETF as a service too, that we talk internally about, right? So ETF as the
Yes.
wrapper for all sorts of strategies. So Mike, let's talk a little bit about, as we start to wrap up, what the future looks like. Index companies, things that, we all thought had so much promise, like non-transparent, semi-transparent structures, have been absolutely non-blockbuster, for lack of a better word. So, as you look ahead, where do we go next?
All right. So you and I have heard this narrative as of late about direct indexing and it's an ETF killer and all that stuff. Well, you know what? Active is killing the index providers. I feel for my friends at index companies right now. Even though they say everything's okay, I don't see how it could be, right? If 9 out of the 10 ideas coming to us as a white label provider are active, and usually the 10th one, after talking to us, the client's like, yeah, why am I going to pay an index provider? I feel bad for them. So they have to counter some way. And so they're becoming more active. They're saying, okay, we're an index provider. Can we provide this through technology to smaller and smaller increments and charge higher and higher fees? Good idea. Right? Like, good for you. I think you should do that all day long because, this is very, very hard to protect your IP at this point as an index provider. Now, the wave of money going into S&P and FTSE and MSCI indexes is not going to stop. I'm not worried about those places, right? uh, like they're going to continue to grow at the rates they have? Probably not. They're not going to get as much of a new bid and new fees unless they change things. But the wave of money that is going to go into Standard & Poor's indexes or MSCI indexes, that's just still unstoppable. It's just math, right? It's random walk. So I do think that there's a huge pivot in those businesses that needs to occur, because the bulk of what's coming to market now is complex product that can't be indexed. And I think that, like, if we go through the waves of the future, right, where we're at that conclusion part where what do we see for active in the future? Number one, way more of it and a challenge for indexes. Number two, way more complex product. Right? Like, very little of what comes to us today is like, I want to buy 50 stocks. Right? Like, and complex is challenging not only for us to do all the back office and stuff, really challenging for capital markets. And we've learned this over the last couple of months. Most market making desks have equity people and fixed income people and commodity people. And guess what? They're not on the same desk and they don't talk to each other. So what people are missing is the more multi-asset class products or options products. They're really hard to get market makers on because they don't have the technology to price it properly. The pipes aren't there. Now, I'm sure they're all building it because they see the wave that's coming. But it's more and more complex stuff. I mean, how many calls are you on with us with a new issuer? How often do you hear crazy new things that you're like, man, I've been hearing we're at the end of ETF innovation since 2012. And
Exactly. I know. And then, and to our, on our own data, categorizing all this stuff, it's getting trickier and trickier because it's so many moving parts on every ETF now.
Well, it's funny because, like,
diligence is a
our own
nightmare.
data, our own data showed you and I that anomaly yesterday that,
Yeah,
holy crap, the oldest active ETF used to be a mutual fund. Like,
yeah,
who knew?
yeah.
And I think that's probably story number 3, mutual fund conversions. I just don't think they have a choice, right? Like, if it's almost like a fiduciary choice, if the same strategy exists in a mutual fund and an ETF, and you're a taxable investor, I can literally guarantee that an after-tax return in the ETF is going to be better than the after-tax return in that mutual fund. Like, I don't get to say that word guarantee ever in finance.
Yeah.
So they don't have a choice. Now, I've seen our competitors like Wes, like, the oldest mutual fund active ETF is on Wes's trust. He talks a lot about how this is going to be a big thing. I know ETC is in the middle of one. We're in the middle of one. I think it's going to be huge for the industry because of things like DFA and JP Morgan. I don't think it's going to be that huge for white label, just because a lot of them they already have everything set up. So when they convert, they're going to use a lot of the same pipes. So I think the ones, I think for white label and what we do, the sweet spot's going to be that 200 to $1 billion mutual fund that's really an independent, and they've already outsourced things. And, so
Maybe
I
more
think it's
so
huge for the
in the
industry.
SMA space, maybe from the advisory channel, we can
Yeah.
see some of that more.
Yeah. I think SMA is the holy grail because it makes it so much better for both the client and the advisor, right? Because going from managing 500 accounts at 3 different custodians and processes and headaches to one account where you just send my team a spreadsheet, like it's it's night and day, and yet, and then your client is also happy. So we've covered that a lot in your papers. So anyone wanting to learn more about those things, why launch an ETF is on the ETF Think Tank website. So, and then let's go to one that has been less of a story. You mentioned it earlier. Ants.
Yes. Active
What are your thoughts on
non-transparent.
ants? I'm gonna flip it. You're the co-captain for a minute. What are your thoughts on ants?
I don't know that I'm surprised they haven't been a bigger story, because I mean, been in this business about 15 years now. We throw the word transparency around like it's a lifestyle. So I'm not surprised that if you can have a fully, to talk Kathy Wood, you can have a full conviction, high active share, transparent active manager. Why would you go non-transparent? I think the value prop of the lack of transparency is not clear to anybody. I think people, they just have been along long enough for us to be at least skeptical of secret sauces. And so I just don't think they have a strong value proposition as a way to do ETFs.
Okay. So I'm gonna say I agree with 98% of what you said there. And I'm gonna pull up something I wrote a couple years ago.
Give me the 2%. Give me the 2%.
Yeah. Yeah. So this is a paper I wrote back in 2020. And it's February 2020, right? So this is right after going to the ETF conference and like 2 weeks before we all get locked down. So I'm sure half of us were sick with it at the ETF conference. And all anybody talked about there was this active non-transparent. It's like what AI today, right? And I came back again, like you, very skeptical. I wrote this piece. I actually came up with an idea at the time that I called the ant colony, a way to make a fully transparent ETF that acts as a non-transparent by having multiple managers. So therefore you don't know which manager is doing what, and it lets the manager hide what they're doing. Turns out First Trust actually took this idea and launched a bunch of ETFs that did it. I haven't gotten my royalty check yet. So, so like, I understand what you're saying on what's happened with these things, because the benefit is not to the end client. The benefit is to the manager, right? So it's not terribly surprising that they haven't really taken off. We have one on our trust now. The operations of doing it have been very hard. Now it's working, but we just did one for Viridian, and day one was not easy, working with the market makers and figuring out what we could and can't say. Do you disclose top 10 holdings if you're a not semi-transparent fund? Like I don't know. So it's complicated. Now, here's the 2%. There is a place where this benefits the end investor, which is, some small cap strategies, international strategies, strategies that use less liquid names would do better in a less transparent wrapper. None of those exist because the regulators aren't allowing these non-transparent structures to do it. So I think what's happened with active non-transparent or active semi-transparent is the same thing the SEC is doing to spot Bitcoin. They slowly took the air out of the balloon to a point where nobody noticed it was empty. So like, they dragged these poor providers like Blue Tractor through all kinds of hell, and then they only let them do it on large cap US stocks, the place where being semi-transparent is the least useful, right? So they've taken the air out of it, and I think until regulators give them more leeway to use the structure to the benefit of end investors instead of to the benefit of the investment manager, I think it's going to have a tough slug. That said, we do get the question quite often on our trust, and we do support Blue Tractor and Presidian and all those. So it's there.
I guess it makes sense.
I think the value prop needs to be there.
was it last year or a couple years ago? Everybody was talking about how Kathy would benefit from a non-transparent wrapper. We talk about interval funds, all that stuff. So I
Yeah.
guess there is a side of, to your point on thematic stuff, where concentration matters, where transparency is not necessarily your best friend. But yeah, I mean, I think I was looking at, there's 52 non-transparent ETFs today. One of them has more than $1 billion in assets. Maybe 15 of them have above 100 million. I mean, it's a space that he really has gone nowhere. So
Yeah.
something's gotta give to really move that needle.
I mean, structures do change. I don't know if you remember a couple years ago, we had ETF MFs. Remember those?
Oh, yes.
Right? So they were like traded intraday, but had a closing NAV, and they had a 5-letter ticker, and
Yeah.
Gabelli launched a couple of them, and it was going to be the new active management wrapper.
Yeah.
Yeah, I don't even think they exist anymore. Are any of those still open?
Good question.
Yeah. We don't track them in our security master because I know I have Margaret
Yeah.
get rid of anything that has more. All right. So the last thing in active, because you can't get through any discussion in
Sure. Go.
2023 without saying AI. AI, 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 AI. It is interesting to me that I think active AI is kind of going to be the replace smart beta, right? I'm still trying to kill smart beta any way I can.
It's
I'm
not
gonna have
going anywhere.
Skynet do it. Skynet's gonna do it. No, but like you look at um Art's fund at Equibot, right? He's came out with a AI managed portfolio, I think like 5 or 6 years ago. Huge fanfare, raises 200 million. Poor guy. I see him on ETF IQ the other day, and what's her name? Katie. She puts up a chart of his fund versus like QQQ. He's getting crushed because the AI knows better than to buy the overvalued crap in QQQ right now. And so like it's so many self-reference paradoxes in this, but I don't see how any indexing company left can survive without embracing this AI concept. Um, I think there's going to be so many products run by AIs with different ways of looking at things. And, you know, active AI funds, I'm sure I'm going to get pitched 100 of them. I'm waiting for your call. Call me and pitch me your active AI fund. Because I, but make it real. I don't want to see more of this. I took ChatGPT and I made 2 tweets to this, and I asked it 3 questions, and I have an active AI fund. Equibot Art has an actual fund. The Kaiju guys, they have something that actually does something with AI. You're going to see more and more of that, and I think investors are going to embrace it. I will say, when Equibot first launched, I was very skeptical. I got to give Eric Balchunas credit. He was really like excited about it. And then like everything kind of died down for 2 or 3 years. And then all of a sudden it's back, and Art's standing there going, "Hey guys, I've been here for 5 years."
Well, and there's we were talking at Eric and I about AIEQ, right, which was the very first
yeah,
one.
that's Equibot.
Yeah, but the AI has to be smart too. In that case, the IBM Watson, one of the things that I think it trades, the turnover on that fund is something like 17,000% a year, where you're gonna get 3% a year on VTI or something like that. So that turnover is eating up the performance, the return. So it's AI
Yeah.
has to be it has to be really smart in order to really be worth the cost.
So it's the AI is solving the problem that the humans gave it to solve.
Right.
That's the biggest problem with
But you gotta
AI.
teach
It's not,
that, you gotta teach AI about trading costs.
well, and not even that. They told it to solve the problem, and they didn't give it the most precise problem. Then, if like the parameters, look, that's the biggest threat to the human race right now is us creating something that's smarter than us and then telling it to do something dumb. Right.
Mhm.
So like the most I've done my deep dive into this lately. I got to spend time with Stuart Russell and whatnot. I'm not afraid of AI. I'm afraid of the humans that
Coding
will
it.
tell AI to do
Mhm.
things.
Mhm.
And it's not, I'm sure Art and Equibot gave it what they thought were the most relevant parameters and things to do. And maybe they were, maybe they weren't, right?
Yeah, I mean,
Performance
that's
will tell over
the
time.
the cost to a first generation anything, you know,
Yeah.
somebody's gonna go out there first and learn how things actually turn out. So it's all good.
Yes.
It's all good.
All right.
All
I
right.
think we've reached the end. Do you have any other things
No,
we should cover?
I think this is an exciting topic. I think you know, we tend to quickly dismiss as, oh, here we go, active versus passive conversation. We're all so tired. We all name drop SPIVA reports, and but I actually think, you know, if you really look at the product development, there's really interesting stuff. I think this move towards complexity is fascinating because for the longest time we talk about simplicity sells, avoid complexity. Now all of a sudden we're embracing
Yeah.
complexity. We're embracing higher fees. We're embracing all sorts of things that 10 years ago we would have said absolutely no way. There's no future in any of that. So I think the whole thing is really interesting.
It really has changed a lot. And like you mentioned studies and that um what's it, Burton Malkiel talked a bunch about those in the podcast I put up earlier. And it's funny because the SPIVA studies are all based on that old version of active management we were talking about. They make categories, large cap manager, benchmark to this. So they're not thinking in SPIVA about the active management that we're talking about.
Mhm.
Active management to achieve exposure to a theme, active management to achieve a higher income through options, active management to use leverage and do things like the active of today racing is very, very different than what the Spiva report or Burton Malky are thinking about.
Mhm.
And I think that's why it's quietly winning so much this year. So in terms of asset growth and adoption.
Yeah. All right, Mike, we'll leave it at that. Thanks, folks, for listening to the captain and following the log. And we'll reach out soon with our next episode.
Sounds
Bye,
good.
everybody.
Thank you.